We've got a problem here, because the US government is struggling to find enough people to borrow money from. So, what are they doing? They're ramping up their rescue operations and intervention. And this is bad for the US government, and it's bad for you and me. So, let me explain. Okay, so why does the government need to borrow money? And the answer is actually pretty straightforward. It's because the US government has an overspending problem. They spend more money than they bring in. This year, the US government is going to spend about $7 trillion. And they're going to bring in tax revenue, tax collections of about $5 trillion. Okay, so how does that happen? How does that work? How do you spend $7 trillion when you only make $5 trillion? The answer is very simple. They borrow the difference. They borrow money from individuals, from private institutions, from other countries, and so on. Alright, that leads us to a very good question. Why doesn't the US government just print the money instead of borrowing it? And the answer is very simple. You have to remember that the US government doesn't have a money printer. That's the Federal Reserve. And the Federal Reserve isn't actually part of the US government. So for the US government to fund its overspending problem, it has to borrow the money. Now, let's answer this question. How does the US government actually borrow money? Like, how does it work? So the US government issues IOUs that investors can buy. They're called Treasury securities. And honestly, you probably have some of these sitting in your retirement accounts. If you've allocated any of your retirement money to a bond fund, a target date fund, a balanced fund, a fixed income fund, and so on. You might remember some of those words, the titles of the funds, from when you were allocating your money. I'm sure you didn't read the fine print. But Treasury bills are IOUs that come due, that mature in a year or less. Treasury notes are IOUs that come due in 2 to 10 years. And Treasury bonds are IOUs that come due in 20 to 30 years. Anyway, what's going on here is very simple. The US government needs money. An investor, which can be you, institutions, other countries, buys a Treasury security, which again is like an IOU, and the US government pays you interest for lending them the money. So basically, anybody holding a Treasury security is being paid interest by the US government. Now, I just want to say it's really important that you understand that bond price and interest rates have an inverse relationship. So I'm going to explain this in a way everybody can follow. Here's the high-level version. If the bond price falls, the interest rate goes up. If the bond price rises, the interest rate goes down. Don't worry, I'll walk through it thoroughly with a simple example. So let's say you need money right now. And let's say I'm an investor willing to lend you money. I want you to tell me which scenario would be better for you and which one would be better for me. Let's look at scenario A. In this scenario, I give you $97 right now, and you pay me back $100 in 1 year, okay? That's scenario 1. The next scenario is that I give you $94 right now, and you pay me back $100 in 1 year. So you, as the person who needs the money, which scenario is better for you? Obviously, scenario A is going to be much better for you. Why is that? Because in scenario A, you're being charged an interest rate of 3% a year, and in scenario B, you're being charged 6% a year. It's as simple as that. As the price goes down, the interest rate goes up. If the price goes up, the interest rate goes down. It's an inverse relationship between the two. And here's something that will make it even easier to understand. We have two scenarios, A and B. In scenario A, you pay $97 for this Treasury IOU right now, and the government pays you back $100 in 1 year. In scenario B, you pay $94 for the Treasury IOU right now, and the government pays you back $100 in 1 year. Now, which scenario do you think the government prefers? Of course, the government prefers scenario A because the interest rate it gets charged is lower. Okay, so why would the price of the Treasury IOU fall from $97 to $94? 294 is that. The answer is that the market does, the bond market, just like there's a stock market, there's a bond market. Bonds go up and down in value, and that changes the yield, which changes the interest rate. Now that you know that, why would the price of a Treasury bond fall in value? Because there aren't enough buyers. It's simply supply and demand. Think of it like the stock market. Say there's a stock out there that nobody wants to buy. If nobody wants to buy that stock, is the price going to go shooting higher? Of course not, because there's no buying pressure. Nobody wants it. That's an extreme example, and I'm not saying there are zero willing buyers for US government debt. I'm just asking, why aren't there enough buyers? Let's answer that. You want to know why? It's because the US government has a severe overspending problem. Looking at the national debt over the past 60 years, it's really been piling up through the 21st century. After the 2008 financial crisis, the government spent money aggressively to stimulate the economy and prevent an economic depression, and that required a lot of borrowed money. Then, after the pandemic, we took it to another level entirely, as you can clearly see. And I'll just say it plainly. Obama overspent more than Bush. Trump overspent more than Obama. Biden overspent more than Obama. And Trump is overspending more than Biden. It doesn't matter which political party holds the presidency, the government is going to overspend and is going to keep adding to this debt. Anyway, this is why there aren't enough buyers. The market is being flooded with US Treasuries. And why is that happening? Because the government needs to borrow more and more money. Right now, they're carrying roughly $40 trillion in debt. Just think about that. You need to find an enormous number of people willing to lend you money if you're asking for $40 trillion. And remember, the government hasn't been paying down its debt balance, it just keeps refinancing it. On top of that, it means roughly another $2 trillion each year, because the government is overspending by about $2 trillion annually. Alright, let's go back to that scenario. Scenario A and Scenario B. Say I do lend you money, I give you $97 right now, and you pay me back $100 in 1 year. Great, everybody's happy. But then say you need more money. You come back and ask, hey, can you lend me some more? And I say, no, I'm good, sorry, I don't want to. You think, oh crap, I really need that money. So you say, okay, how about you just give me $96 right now, and I'll give you $100 in a year? And I respond, no, I'm good. I don't have any more to lend you. I don't want to lend you anymore. So now you're thinking, okay, I've got to ask my friend Jose for money instead, since I'm not going to get it from my original lender at that rate. So you go to Jose and ask, can you give me $97 right now, and I'll give you $100 in a year? Jose says, nah, I don't want to do that. You say, okay, how about $96? Give me $96 right now. I'll give you $100 in a year. Jose shakes his head. Nah, he doesn't want to go along with it. You say, okay, just give me $95 right now. I'll give you $100 in a year. Jose still doesn't want to do it. You say, okay, give me $94 and I'll give you $100 in a year. And Jose says, okay, fine. I'll give you $94 right now and you give me $100 in a year. So do you see what happened? You had to sweeten the deal by giving Jose a better interest rate. Why? Because you couldn't find enough people willing to lend you money at that lower rate. That's why. And notice, you went straight to Jose because you already knew your cousin wasn't going to lend you money, and your little brother wasn't going to lend you money either. Some of you are thinking, I don't even have a little brother. But that's exactly the point. There aren't enough people willing to lend you money at your desired rate, so the offer has to be sweetened at your expense. And that is exactly the problem the US government is facing right now. It's issuing trillions of dollars of these IOUs, these Treasury securities, every year, and now it's having trouble finding buyers. That's why the interest rate on Treasury bonds has been climbing higher. Looking at a 5-year chart, the government was able to get people to lend to it at a 1.7% interest rate about 5 years ago. Now it's above 5%. And think about that. The government needed $1.8 trillion last year. It's going to need $2 trillion this year. And next year, it's probably going to be more than $2 trillion. So where are they going to find all these people willing to lend to them? There simply won't be enough lenders at 2%, or 3%, or 4%, or even 5%. And if the interest rate climbs to 6%, the government's fiscal budget is going to be in serious trouble. Take a look at this. This is how much the government has been paying in interest on its debt each year. In 2020, the interest expense was about $345 billion, and it's climbed higher and higher every year since. In 2025, it was $970 billion in interest expense, more than we spent on the military. This year, in 2026, it's projected to be about $1.1 trillion in interest expense. That's staggering. And remember, that's just the interest. It's not paying down the debt at all. That's a huge amount when the government's total revenue is only about $5 trillion. It's like a household that makes $100,000 a year paying $20,000 a year in credit card interest. And that's just the interest, not even touching the balance. It's a genuinely bad situation. So a very good question is, where are the buyers of these Treasury securities, the people actually willing to lend money to the US government? Let's look at foreign lenders. Here are the largest foreign holders of US Treasury IOUs. Japan holds $1.1 trillion in US Treasuries. In other words, the federal government owes Japan $1.1 trillion. So will Japan be buying more US Treasuries? Will they be lending more to the US government? My expectation is no way. No way, because Japan is going through its own currency crisis right now. And it's actually been selling US Treasuries, which doesn't do the US government any favors. The US government needs buyers of Treasuries, not sellers. Selling is the opposite of what it needs. That hurts the US government and pushes interest rates up. Japan has at times threatened to sell a large amount of its Treasury holdings, which is part of why the US government and the Federal Reserve had to step in, the yen crisis intervention, to try to keep Japan from dumping those treasuries. Because if they did dump them, bond prices would fall and US interest rates would rise. Then there's the United Kingdom. Come on, the UK is stretched thin. Do you think they have a meaningful amount of money, the kind of quantity that would actually make a difference to lend to the US government? No, they don't. And China isn't going to help either. They're not lending us money. China has been selling its Treasury IOUs and buying physical gold instead. They've got other priorities for their money, so they're not going to lend to the US government. No way. And do you think our allies in the Middle East are in the mood to lend us money right now? I don't think so. So what happens when there aren't enough people willing to lend the US government money? Interest rates go up, and the US government can't financially afford that. So what's the game plan? What do they do? Where do we go from here? Here's what's actually happening. The Federal Reserve is turning to its money printer. For 2026, they're already in the process of printing about $200 billion, and they're using that money to buy Treasury IOUs. Why? So that the price of Treasuries goes up and interest rates come down, so the government doesn't have to pay higher rates. And of course, that raises the question, is that inflationary when the Federal Reserve prints a bunch of money out of thin air like that? Yes, it is, but the mentality of the US government and the Federal Reserve is that there are bigger fires to put out first. So that's the Federal Reserve's piece, but it's not enough on its own. There still aren't enough buyers of treasuries at the rates the government wants. So the US Treasury has had to step in too. Now the Federal Reserve and the Treasury are effectively tag-teaming this problem. Starting in July 2024, the Treasury began buying $8 billion of treasuries every quarter, every 3 months, a rate of $32 billion a year. That wasn't enough. Then in 2025, the Treasury increased that to $16 billion per quarter, essentially doubling the pace, $64 billion a year. And now, as of August 19th, 2026, the Treasury is increasing it again to $32 billion a quarter, a run rate of about $128 billion a year. So you've got the Federal Reserve spending roughly $200 billion this year buying up US Treasuries to artificially push up the price so that interest rates get capped and don't keep shooting higher, or hopefully come down a bit. And you got the Treasury spending roughly $128 billion buying up US Treasuries, again, to artificially push the price up. Call it about $300 billion combined in intervention, money, rescue operations. But it's still not going to be enough. Why? Because each year, the deficit this year around $2 trillion means $2 trillion of additional borrowing, $2 trillion more of Treasury securities flooding the market. And you're talking about only $300 billion of intervention money against that. So what's likely to happen? Here's how I see it. The Treasury is intervening at a run rate of $128 billion a year. But it could always ramp that up further, say, hypothetically, from $128 billion a year to something like $200 billion a year to something like $200 billion a year. But that's still a massive sum for the US government to come up with. And remember, the US government itself doesn't have a money printer. So what they'll likely do is some financial engineering, swapping out some long-term debt for short-term debt, essentially refinancing the mix. But that doesn't actually solve the underlying problem. The way I see it, none of these moves really solve it. The Federal Reserve is going to end up being the last resort, the one with the actual money printer. And when they print, they're going to print a lot because they'll need enough to actually make a difference. And that, of course, is going to spike inflation. And that's exactly why this is bad for you and me. It's worth bringing in a different lens here, the one Warren Buffett has spent decades hammering home. Buffett has long argued that debt is what turns a manageable problem into a real crisis. Leverage, in his words, is how otherwise smart people get themselves into serious trouble, and you don't need debt to do well over time, but careless borrowing can wipe out years of good decisions almost overnight. He's also been consistent that the goal isn't predicting exactly when a crisis hits, but making sure you're positioned to survive one holding quality assets, staying conservatively financed, and keeping enough of a cash cushion that you're never forced to sell at a bad time. His well-known line about being fearful when others are greedy and greedy when others are fearful applies directly here. When a government is essentially printing its way out of a funding shortfall, that's usually a signal to protect purchasing power rather than chase yield. Buffett has also pointed out, more than once, that inflation behaves like a hidden tax. It never shows up as a line item on a bill, but it quietly erodes the value of cash and fixed income holdings alike, which is exactly the risk building up in this picture. I know what they're doing. I know what they're up to. They're going to try to inflate the debt away, but it's not going to work. It's like these people have never picked up a history book in their lives. The government's playbook isn't complicated once you look at the mechanics. It's fairly easy to read, and it's pretty obvious what they're trying to do and where this is headed. And a fun fact worth sharing, there's a reasonably high probability that 2027 turns out to be a strong year for the markets, because the third year of a presidential cycle has historically been the strongest year by a wide margin. Thanks so much, and wish you an excellent day.